Hello everyone, welcome to JAIIB CAIIB Prep. In today's video, we'll discuss about unit number 25, types of collateral and their characteristics. So in this particular video, we'll understand about different type of securities like land and building, loan against goods, types of shares, how a person can get a loan against shares, LIC, gold loans, term deposit loans, supply bills, vehicle finance. We'll do some practice questions in the end. So without further ado, let's start today's video. So lending by bank is always associated with risk because there is no absolute certainty that a borrower will repay the loan. The biggest risk for the bank is credit risk, which means the possibility that the borrower will fail to pay back the loan on time. To reduce this risk, bank generally ask borrowers to provide security, some asset or property that the bank can control if repayment does not happen. So when banks give loan, many times the money borrowed is used to create assets such as house, machinery, uh, business equipments. The bank then take those assets as security. If the borrower does not repay, then the bank shall have a cushion to fall upon, and the bank can sell these assets and recover the money. Apart from this, bank may also ask for collateral, which is any other asset belonging to borrower or even a third party. However, not all loans are given against security. So there are unsecured loans as well, which is known as clean loans. So in short, to reduce credit risk, bank take security. If borrower fails to pay, bank simply sell this asset and recover the money. Effectiveness of security. So the usefulness of the security depends on two aspects: economic and legal aspect. Economic aspect is whether the security has a stable and reliable value in the market. If the market price keeps fluctuating too much, or if the asset is not easily saleable, the security becomes less effective. And the legal aspect is whether the bank can legally enforce its right over the asset and sell the security when needed. So security particularly depend on these two aspects. For a security to be a good security, it must meet certain requirements. So it should meet certain characteristics in order to be called a good security. The borrower must be the true owner of the security, so there must be a clear title. Secondly, the asset must be easily identifiable, so there is no dispute with regard to security. So it should be easily identifiable, it should be freely transferable, it should be transferable and free from any legal burden. Ownership should be absolute. There should be no uh, encumbrances involved to it. So the ownership should be absolute and not partial. It must be marketable and have a stable price. It should be easily marketable. Mm, its value should easy to determine. If placed, it should be possible to store it safely, and the asset should be durable and last for a reasonable time. Secured versus unsecured assets. So secured asset is one where the bank takes security against the money it lends. This security can be in the form of immovable property like land and building, or movable property like vehicle, gold or stock, or other valuable assets like bonds, shares, insurance policy. So if the borrower fails to repay, the bank can simply sell the security and recover the money. For example, a person takes a home loan. So this person goes to the bank and takes a home loan. Now, in this particular scenario, the house itself becomes the security. So, if a business borrows money for machinery, then the money can be placed as security. Uh, Most banks loan in India are secured because they reduce the risk of the loss for the bank. Secondly, is unsecured loans. So an unsecured loan, as the name suggests, is given purely on the borrower's credibility and repayment capacity without any tangible security. So here the bank relies only on the borrower's promise and financial strength. Such loans are riskier for bank because if the borrower default, bank has no direct asset to claim. Uh, Unsecured loans are also known as clean loans, and recovery depends on legal action against the borrower, which may not always be effective. Now, which class of loan will be preferred as a bank, secured or unsecured? So, simply, uh, without any doubt, banks prefer secured loans because the borrower's business may fail due to economic factors. If there's no security, the bank may lose its money, and security gives the bank a cushion to fall back on if a repayment fails, and also it acts as a psychological pressure on the borrower to repay since their property is at stake. So, in short, a secured loan reduces credit risk while unsecured loan increases it. Types of security. So there are four types of security: immovable, movable, financial assets, and intangible securities. So immovable property includes land and building. Simply the security which you cannot move from here to there. So land and building, a machinery which is fixed to the ground. Movable assets include goods, vehicles, gold ornaments, crops, etc. Financial assets or actionable claims include receivables, shares, bonds, insurance policy. Intangible assets are those assets which you cannot see or touch, like goodwill, brand value, intellectual property. And for banks, an ideal security should be sellable in the market. It should be easy to value through reliable sources. It should be stable in the price, so there should not be very much fluctuations, and it should be transferable without lengthy legal formalities. Uh, Securities can also be classified into primary security and collateral security. So, primary security is the direct asset for which the loan is granted. So, it is the direct asset for which loan is granted. For example, if a loan is taken to buy stocks for business, the stock itself is the primary security. Or for that matter, if an individual takes a home loan, so the house itself is the primary security. Collateral security is any other asset offered additionally either by the borrower or the guarantor. So, a borrower may mortgage his house as security for a business loan. So, in that particular scenario, this house becomes a collateral security. So, this is additional security. Now, let's move on to types of securities. We start with land and building. So, the nature of the land and building is not self liquidating, unlike goods. Um, or stocks which can be sold quickly in the normal business cycle. Land and building do not automatically generate cash to repay. If repayment fails, the bank has to sell them, which usually involves a legal process. Earlier, banks avoided land and building as security because of difficulties in valuation and legal complexities. But today, with law like SARFAESI, uh, banks can sell mortgage property without going through a long court process, without going through a long legal process basically. So making it popular for collateral, especially in corporate loans. The nature of security is mortgage. So in the next unit itself, we'll understand about various types of securities that can be created in the market, like pledge, hypothecation, um, mortgage, lease. So we'll understand about those securities in the next unit. Now, what are the advantages and disadvantages of land and building? So, first advantage is the value appreciation. Generally, the value of land increases over time due to inflation and scarcity, especially in developing or urban rural areas. Second is traceability. So, the land and building will not move. So, it is easily traceable. It cannot be moved. Then again, it is a stable security. In most cases, land is strong long-term asset for banks. So, it is a stable security. Now let's talk about some of the disadvantages. Like it is very difficult to value a land. A building's worth depend on location, construction quality, age, amenities, surrounding developments. Industrial buildings again depend on factors like machinery, industry type. Since buyer differs in preference, valuation must be done conservatively. So keep that in mind. Whenever we do valuations, we while providing the loan, we do it conservatively, right? Then title verification can be an issue. The borrower must have a clear legal title. In India, succession laws and incomplete land records often create confusions. So lawyer must check documents in the registrar's office to confirm ownership and verify that the deeds are genuine. Then we have encumbrances. So third party claims can be there. The property might already be mortgaged, disputed in the court, or under government attachment. So banks need an encumbrance certificate to ensure it is free from prior claims. Liquidity is a problem because selling land takes time. The market may be slow, sale price may be lower than expected, cost may be high. Creating a mortgage involves stamp duty, registration fees has to be paid, which can be significant. Rent control issues can be there. So if the building is occupied by long-term tenants under Rent Control Act, the property becomes harder to sell and it loses its value. Agricultural land issues can be a disadvantage to the bank because there are land ceiling laws, incomplete records, restriction on transfers. So these are certain disadvantages of the land and building as a type of security. So when we understand about type of charges, we'll discuss in detail all about mortgage, pledge, hypothecation. So in this unit, we'll give a passing reference like what type of charge will be created, and in next unit, we'll understand in detail about those charges. Now, what are the documents required by the bank, the mortgager? So to safeguard their interest, bank collects several documents before accepting land and building as security, like title document, sale deed, gift deed, partnership deed, which provides the ownership. Then parent document, historical ownership record, which is usually for 30 years. Encumbrance certificate, typically for 13 years, which show whether the property is free from earlier mortgages or claims. Property tax receipts, it is a proof that borrower is in possession of the property. Court permission is required if the property is in minor's name. Court approval is needed in that particular case. Search report for company owned property. Bank check registrar of companies record for charges. And then there is a lawyer's report. The lawyer's legal opinion. Legal expert certifies that the borrower has clear marketable titles. Valuation of property. So before sanctioning the loan, banks get their property valued. This is done by approved valuers, which are engineers or architects. Inquiries with real estates are done for the valuation purposes, checking recent sale price of nearby properties, referring to official records or municipal valuations, and then rental value calculations are done. There are various factors considered while doing the valuations, like type of construction, age of building, conditions, nature of title, whether it is a freehold or leasehold, location and area, tax records, rent yield, cost of construction, and as stated earlier, valuation must be done on conservative basis. uh, meaning to say if we are forced to sell, what is the price that this security will fetch. Ownership types, so particularly we have freehold and leasehold. So freehold is owner has full permanent right over the land. It is easier and more secure for the bank. Then we have leasehold, so property is owned only for a lease period, say 99 years. This is prevalent um, in states like Uttar Pradesh. So value depends on how much lease is left. So bank check lease deed carefully to ensure there are no restrictions like requiring landlord's consent to mortgage, or loan repayment should not go beyond the unexpired lease period. In other aspects, basically inspection is done. So bank officials physically inspect property to confirm its existence. A mortgage deed must be carefully drafted and legally valid, which is witnessed by two people. It is witnessed by two persons. Insurance should be there, so the building should be insured against fire and natural calamities at the borrower's cost to protect bank security. And if the loan is given against land or building as primary security, the bank clearly specify that loan purpose. Now, um, let's move on to goods. So, advances against goods. A bank often provide loan to customers by taking goods as securities. These goods can include agriculture produce, raw material, semi-finished goods, or finished products. The choice of goods depend on the borrower's line of business. Since goods are tangible and have a market value, they are considered reliable security. But again, their nature, storage, and value fluctuations are carefully be evaluated. So there are two types of charges which can be created with respect to this security. So it is pledge and hypothecation. Pledge is particularly governed by Indian Contract Act of 1872, and this is governed by SARFAESI. Um, so the pledge is when possession lies with the bank. Here the possession remains with the borrower, but the charge is in the favor of bank. So in both cases, the ownership remains with the borrower and not with the bank. But again, the possession is transferred in case the nature of charge is pledge. It is not there if the nature of charge is hypothecation. Characteristics of goods as securities. So when goods are offered as securities, bank must study their key characteristics like natural durability, how long the goods can be used or consumed. For example, the fruits, food grains, or is it the chemicals? The physical strength, which is the ability to withstand force, pressure, or damage. So glass, rubber, they have different physical strengths. Chemical nature, so whether the goods react with air or moisture or stay stable. So brass goods, salt, so they have different reactions with the atmosphere, right? Utility products, so it affects of long storage or appearance and composition. Fashion and lifestyle, effect of changing fashion trends on demand. Technological obsolescence, basically risk of goods losing demand due to new technology. Seasonable variability, it depends on demand depends on the season. And then intermediary goods, so the semi-finished or components used for other products. Now let's talk about the advantages and disadvantages of the goods. So with respect to advantage, goods have ready marketability, so goods can be used usually be sold easily if the borrower defaults. Valuation is simple and straightforward. So market price and invoice makes valuation simple. Tangible security, unlike unsecured loans, goods provide physical security, usually given for short periods, which reduces the risk. They are short-term advances. They are cheaper. The charge is charge created is cheaper than uh, land and building. So, except in few states where the stamp duty is heavy, the cost of creating the charge is low. With repeated borrows, goods can be obtained. Bank can obtain valid rights over the goods. So, good title to the goods is possible when dealing with the repeated customers. Now, let's talk about the disadvantages. Goods like food grains or fruits, they deteriorate with time, so the perishability is an issue. Second, the risk of fraud is always there. Borrower may represent stock claiming that there are 10,000 tins, but again, some of the tins can be empty. So, risk of borrower fraud or manipulation in stock statement is a possibility. Market value may fluctuate, particularly for electronic goods or luxury goods. The market value may fluctuate. Uh, Valuation is difficult for certain items like antique items, diamonds. In that scenario, valuation is difficult. Selling large quantity of goods may reduce the price, so disposal may be a problem for bulk goods. Storage challenges are always there, so storage difficulties for bulky, hazardous, or delicate items which need careful handling. Cost of transportation is high. Moving goods to the market may be costly. Risk of default when goods are released under trust receipt. A borrower may not deposit sale proceeds with the bank, so there's always a risk of default on sale proceeds. And then warehouse keepers may hold goods for unpaid charges. Precautions which a bank may take before granting advance. So borrower must be genuine trader with sufficient experience. No advance for speculative or holding purpose. So this is true in every scenario. Whether you are providing loan against land and building, whether you are giving loan against gold, whether you are giving loan against shares. So no advance should be there for speculative purposes. Loan should be short term due to risk of deterioration. So short term loans only. Bank must obtain possession, actual or constructive, doesn't matter, but the possession should be with the bank. Written undertaking in case of hypothecation that the goods will not be given, uh, the goods will not be charged elsewhere. So for hypothecation, written undertakings should be given. Regular stock verification, borrower certificate on quality and value should be obtained. Proper care and storage should be done in order to prevent damage. Goods must be uh, the goods must be carefully stored, and the goods must be fully paid for avoiding double financing. Stock must be in demand and not obsolete. You verify borrower's ownership using original invoices. Maintain stipulated margin. Always separate storage of different goods for easy checking. Banks must study goods price, trend, market demand, storage needs. There should be adequate insurances against fire, theft, riot. Storage location must be easily accessible and it should be safe. And in case of warehouse, storage obtain undertaking for inspection, rights, and check that charges are paid regularly. So these particularly uh, precaution 15 to 16 precautions should be taken while granting advance against the goods. Inspection and monitoring. So storage requirements are there. So goods should be stored properly in proper go down with weather protection. Hazardous goods must be kept separately, and storage should always easy to access for inspection. So bank official must conduct regular inspections, and the storage. should always allow easy access for inspection. So regular inspection, at least monthly, plus surprise checks are there. Why at the time of inspection, count the bags, cartons, open random samplings. You verify with the purchase or sale registers, the GST paid, the excise records. You take the remarks in bank's internal reports. Do not put any remark on borrower's book. So remarks should be recorded in bank's internal records. Stock audit is there. So it is mandatory for working capital accounts above 5 crores. So stock audit is mandatory. It helps monitor stock levels, quality, and the borrower's financial health. Warehouse receipt, so it must be issued by approved warehouses. So advance against warehouse receipts. Uh, the warehouse receipt must be approved by warehouses, approved warehouses, government warehouses. Goods must match the description in receipts, and insurance and ownership verification is necessary. Valuation of stock. So stock value is the quantity multiplied by the price. Now again, valuation should be done on conservative basis. So valuation is usually done at cost price or market price, whichever is low. For non-moving or obsolete stock, discounted value is applied. Uh, Valuation method. So you cross-check with the purchase invoices. You engage professional valuers, independent valuers to determine the value. Market price reference are taken. So verify the prevailing market price. The quantity assessment should be correct. It is critical. Do not overstate the stocks in the stock statement. There's always a risk of overstatement. So quantity assessment should be done properly. Margin and recovery. So bank maintain a margin before calculating the drawing power, of the amount which can be lent to the borrower. So for example, stock value is 1 CR. Bank is maintaining a margin of 25%. So the drawing power is 75 lakhs. Bank will keep this 25 lakhs as margin. So adequate margin must be maintained. In case of default and the nature of charge is hypothecation, bank can take possession and sell goods under SARFAESI Act without court intervention. But again, it is subject to certain conditions. And in case the nature of security, in the nature of charge is pledge, bank can sell pledge goods after giving reasonable notice under section 176. So if it is hypothecated, bank take the possession and then sell goods. If the nature of charge is pledge, bank already has the possession, bank only needs to give a reasonable notice to the borrower, and then bank can sell the goods. Document of title to goods. Document of title of goods is defined under section 2 subsection 4 of Sale of Goods Act. A document of title to goods, it is a document used in ordinary course of business as proof of possession or control of goods, which authorizes either by endorsement or delivery the possessor of the document to transfer or receive the goods. So basically, if you have the receipt, you will get the goods. So these are documents that represent ownership or the possession of goods. So whoever holds these documents can transfer or claim the goods. For example, bill of lading, dock warrant, warehouse keeper receipt, railway receipt, delivery order. So if you have these receipts, you can claim the goods. There are certain essential requisites which we need to understand. One more thing, uh, they are different from non-transferable documents like where a simple warehouse receipt. So it is not a mere acknowledgement, but it creates ownership. It intends to give the goods whoever has this document. So essential requisites include mere possession gives right to possess goods represented, meaning to say it create right to possess the goods. So possession of such a document gives legal or trade right to possess the goods it represented. Goods can be transferred by endorsement or delivery of the goods. The holder can receive goods in his own name, so transferee can take delivery. They resembles negotiable instrument, but they are not truly negotiable because a defect in the transfer title also affects the right of transferee. M- merits involves easy pledge. So by pledging the document, the underlying goods are pledged. Transferability is one of the merits. So simple endorsement or delivery transfer the goods. Transferee can claim delivery directly, and then the formalities involved are very less, so it is easy to use as a security. Demerits: documents do not guarantee the content, so bags may contain worthless items, so a risk of fraud is always there. Quantity and quality may be tempered, so forgery or alteration risk. They are not fully negotiable. Defect in transfer title pass on to the transferee, so not fully negotiable. Unpaid vendors right of stoppage, so seller can stop goods in transit if unpaid, which reduces banker's security. Lost documents, so borrower may misuse indemnity bond to claim goods fraudulently. Precautions required from bankers end: you check the genuineness, verify authenticity, date, and completeness. All the copies of bill of lading should be obtained, which are usually in duplicate or triplicate. So all the copies should be obtained. Ensure no remarks about damage or defect good is there. They must be insured against fire, theft, transit risk, marine risk, if marine risk is applicable. So whichever risk is applicable, the insurance should cover that risk. And bank's name should appear as consignee for safe title. Trust receipt. So when a bank releases document of title to a borrower without a payment, it should take a trust receipt. Similarly, for hypothecated goods, a trust receipt is necessary. So why are they important? Because borrower must hold sale proceeds in trust for bank, and it protects bank in case of borrower's insolvency. The typical clauses which need to be incorporated: borrower acknowledges bank's right in goods. It undertakes to hold goods or sale proceeds in trust. It undertakes to insure and store goods properly. The borrower agrees to direct buyers to pay directly to the bank, and to return unsold goods or disposes as per the bank's direction. Advance against life insurance policy. So bank may also grant advances against life insurance policy either as primary security or collateral security. But the purpose for taking life insurance policy is to provide financial support to dependents after the death, and it can also serve as a saving tool with tax benefits and loan eligibility. So, what are the advantages of life insurance policy as a security? So, it is a reliable security. Life insurance business is regulated. Claims are paid if policy is valid. Then easy assignment is there. Uh, the legal procedure is simple, which give bank perfect title. Longer the duration of the policy, higher is the surrender value. So uh, it increases the value over time. On borrower's death, loan can be repaid from policy proceeds, so it acts as a debt protection. Policy can be surrendered in case of default, so immediate realization is there. And policy remains with the bank. Only premium needs regular monitoring, so it's a tangible security in bank's custody. Uh, every coin has two sides. Every type form of security comes with advantages and disadvantages. So there are disadvantages associated with life insurance policies as well. A lapse risk is there, meaning to say if premium is not paid, policy lapses. Misrepresentation makes the policy void. So good faith requirement is there. Policy without insurable interest is void. So the proposer must have insurable interest in assured's life, meaning to say a person taking life insurance policy in the name of his or her neighbor or a random person, this is not allowed. The proposer must have insurable interest. Bank should check for the restrictive clause which may reduce insurer's liability. So if there's a restrictive clause, it will reduce the liability of the insurer. Married Women Property Act needs extra care in assignment. So policies under this particular act, Married Women Property Act, they need extra care. Duplicate policies, risk is always there. The risk of duplicate policy. So the borrower may misuse duplicate copies. Now, what are the precautions required to be taken? The policy must be enforced with the latest premium paid. Original policy document, which is stamped and signed, is required. There should be no restrictive clauses. The policy should be free from restrictive clauses. Restrictive clause basically reduces liability of the insurer. The age of assured must be admitted. Policy must be assigned in bank's favor and it should be registered with the insurer. It should be ensured that the premiums are paid regularly. Some policies cannot be accepted as securities, which include child endowment policy, estate duty policies, deferred child policies, and policies with uh, nominations under Married Women Property Act. So, valuation of security or the loan basis. So, bankers lend on the surrendered value. So, surrender value is basically the amount insurer will pay if policy is surrendered. Assignment of policy. So, assignment can be on the policy itself or on stamped paper. Again, it must be witnessed. Nominees consent uh, if not needed, because nomination gets cancelled automatically. So, nominees' rights are cancelled after assignment. So, their consent is not required. Assignment is valid only after written notice to the insurer company, to the insurance company. So, assignment is effective only after written notice. On repayment of loan, bank reassigns policy back to the borrower, and bank may also accept Kisan Vikas Patrikas or National Savings Certificates as additional securities along with the policy. They can also accept these documents. Advance against shares. So when a person or company needs money, they can approach a bank and pledge their shares, equity share or preference shares, and the bank then provide loan or overdraft against those shares. So equity shares give ownership in a company and the voting rights, and preference shares give priority, the preference over equity shares in dividends and repayment of capital. Again, shares can be listed shares or unlisted shares. So listed shares are those shares which are traded on stock exchange, which are easy to sell and value. And then there are unlisted shares which are not traded on exchanges. They are difficult to sell. So bank usually avoid them. So bank usually accept listed shares, which are fully paid up shares. They do not give loan against private company shares because there is no ready market for selling them. If the borrower default, bank cannot simply go here and there and ask persons whether they want to buy the shares of this private company. So banks generally accept listed equity shares. Again, the purpose should be productive purpose and not speculation purposes. So advances must be only for productive purposes and not speculations. Loan should not be provided to gamble, right? The nature of charge which is created on shares is pledge, meaning the shares remain in borrower's name but cannot be sold without bank's permission. And nowadays, bank insists shares to be held in demat form to make pledging simple and secure. Advantages. So the valuation is easy. Market prices of listed shares are available daily. Stable value of shares in normal times. So normally blue chip stocks are less volatile than other commodities. In demat form, the formalities required are very less. Depositories make it easy to confirm the ownership, like who owns the share. Uh, Cost of charge creation is cheaper than the mortgage. Uh, Shares also generate income via dividend, which can be adjusted against the loan. Release is very quick, so it is easy to return shares after loan repayment. Now let's talk about disadvantages. Since shares are liquid and easy to transfer, they can be misused if not properly secured. If they are partly paid, then the borrower may need to pay the future calls. Price fluctuations are possible, so in certain times there are very high price fluctuations, and sometimes due to restricted market they are not easily sellable. Now, because of these risks, banks prefer only fully paid up listed shares. Precautions which is required to be taken by banks: maintain an approved list of shares that the bank will accept. Update the card limit, so the maximum loan allowed per share regularly. For example, if the share of Infosys is 1500, the bank will provide say 1000. If the share of a particular company which is newly listed, say ABC Limited, so the bank will not provide loan against this the share of this company. It should be mentioned in this list, and this price, like what is the credit card limit which the bank will provide. So the maximum loan value against per share. Periodic review should be there. So portfolio should be reviewed yearly or even more frequently depending on the stock market volatility. If we are accepting partly paid shares, which is in rare cases, don't transfer them into bank's name. Ensure calls are paid on time. Keep sufficient margin to cover the risk and verify the details in demat account. So in rare cases, if the loan is provided against partly paid shares, then these four requirements need to be fulfilled. Statutory limit. So statutory limit is provided under Banking Regulation Act. So section 19 subsection 2 of the Banking Regulation Act 1949 provides a statutory limit on shareholding, which states that a bank cannot hold shares of any company as pledge or as owner exceeding 30% of that company's paid up share capital, or 30% of the bank's own paid up share capital plus reserves, whichever is less. So this 30% is a statutory limit. And this ensures banks don't end up holding too many shares of one company, which could expose them to excessive risk. And it applies to all shares, whether physical or demat form. Regulatory regulatory exposure limits. So banks' exposure to the stock market include direct and indirect exposures. So direct exposures means investment in equity shares, convertible bonds, convertible debentures, or equity mutual funds. And indirect exposure includes loan against shares, loan to individuals for IPOs, ESOPs, loan to companies secured by shares, financing to stockbrokers, underwriting commitments, exposure to venture capital funds. So basically, bank is not directly investing in the equity market, but taking an indirect route. Now, there are exposure limits on solo basis, like individual banks. The total capital market exposure should not be more than 40% of the bank's net worth, and the direct exposure should not be more than 20% of the net worth. So, in this 40%, the direct exposure should not be more than 20%. And on consolidation basis as well, this limit remains the same 40%, 20%. There are exceptions. So equity which is received due to restructuring of NPS, it is one of the exception. And secondly, loans for government PSUs disinvestment program which are specially approved by the RBI. So these two are the exceptions for this exposure limits. General guidelines for advances against shares. So follow statutory provision. Firstly, secondly, the purpose of the loan is more important than the security. The purpose should be protective purpose and not a speculative purpose. You keep advance against shares separate from other loans. Verify marketability, financials, and reputations of the company whose shares are pledged. Again, value shares at current market price and not on the historical prices. uh, you should be careful of the large block of shares. Ensure that they are not used for taking control of the company. Never lend against partly paid shares. So no lending against partly paid shares. Proprietorships or partnerships cannot take loans primarily against shares. If loan is greater than 10 lakhs, you transfer the shares to bank name, and bank may decide how to use the voting rights. Ensure securities are genuine. Board of directors should fix internal guidelines and authority levels. And Indian banks cannot help overseas branches finance Indian national to invest in Indian shares. There are margin rules which should be followed. So, a uniform margin of 50% on loans against shares and IPOs, and within this, at least 25% must be cash margin. So, in case of guarantees for capital market operations, so 50% margin and 25% margin should be applied. Loans to individuals. So, purpose is personal needs, subscribing to the issue, or secondary markets. So, subscribing to new issues include IPOs, FPOs, right issues. So, these loans are meant to support genuine investment or personal requirements and not speculation requirements. There are ceiling to the loans. So, if securities are held in physical form, maximum 10 lakh rupees can be granted as loan as an advance to the individual, and 20 lakh rupees can be granted if securities are in dematerialized form. So, if they are in demat form, maximum 20 lakh rupees per individuals can be granted, and this ceiling ensures that the risk exposure for the bank remains controlled. Uh, you should prevent the collusive action as well. So, there should be prevention of. So, basically, these loans should not be misused by the group of individuals linked to corporates to artificially inflate or support the prices of a particular share. So, if multiple individuals take loan to the same share, the exposure is treated as capital market exposure for the bank. And banks have a lending policy, so every bank must have a loan policy for such advances, which is approved by its board. Purpose has to be ensured. The it should be productive purpose and not speculative purpose. Financing of IPOs. So bank may provide loan to individuals specifically for subscribing to IPOs or FPOs, fresh public offerings or initial public offerings. There is a ceiling of 10 lakh per individual across the entire banking system, and corporates are not allowed to take bank loan for investing in other companies' IPOs. Such loans are treated as capital market exposure for the banks, and both IPOs and NPOs fall under this category. Finance for ESOPs. So bank may support employees in buying shares of their own companies under ESOPs, employee stock option plans, or employees quota and IPOs. But again, there is a ceiling. So employees may get up to 90% of the price or 20 lakh rupees, whichever is lower. So the extent of finance which is allowed is 90% of the price or 20 lakh rupees. Such loans are treated as capital market exposure, so they are counted within that 40% limit. And banks cannot finance their own employees to buy shares of their own bank under ESOPs or IPOs. And this applies irrespective of whether the loan is secured or unsecured. The logic is basically to prevent conflict of interest and safeguard the independence of banking operations. Employees borrowing for ESOPs or IPOs, they must provide a declaration of other loans taken against shares, securities from other banks, so that the ceilings are not breached. Loans to stockbrokers and commodity brokers. So only the SEBI registered stockbrokers and commodity brokers who meet SEBI or stock exchange capital adequacy norms get the loan. There are two type of credit facility which is provided to them. Number one is overdraft or line of credit against shares and debentures held as stock trade. Secondly is working capital to cover temporary cash flow gaps in delivery versus payment transactions for institutional clients like foreign institutions, mutual funds, banks. So banks must check the borrower's financial strength, turnover, income, and the marketability of the pledge secured. Margin requirements are same: 50% for loans, IPOs, or financing guarantees, and within that, at least 25% cash margin for guarantees in favor of stock or commodity exchange. Uh, there are certain restrictions like no credit for arbitrage operations, and uh, sh- it should avoid nexus with interconnected borrowers. Market makers. So, who are market makers? Entities approved by stock exchanges to provide liquidity in securities. They are the eligible securities include equity, debt securities, government securities. Then there are financial rules. So, finance should be need based working capital. Margin is same: 50% margin on advance guarantees with 25% minimum cash margin. Loans cannot be diverted for investment in unrelated shares. That has to be kept in mind. Finance for margin trading. So borrowers money to you buy shares by pledging those shares to the bank is known as margin trading. So borrowing money to buy shares by pledging those shares to the bank, this is margin trading. Must be within 40% capital market exposure. 50% of margin has to be maintained, and share must be in demat form and placed with the bank, and bank must continuously monitor the margin. As a safeguard, bank should avoid nexus with interconnected borrowers and spread financing among several borrowers to prevent concentration risk. Loan policy for brokers and market makers. So each bank must frame its own loan policy covering the purpose and permissible use of advances or guarantees. The pricing, the risk control features should be unique to capital market lending. Valuation methods and frequency of valuation should be determined. So at least quarterly revaluations of collateral should be there. Transfer rules, if shares need to be in the bank's name, so the loan policy must include this aspect as well. The periodic review and the exposure limits are also mentioned in this loan policy. So, if shares are in joint names, bank must be careful not to bypass RBI limit. For example, if A and B hold share jointly, say a person named A and a person named B, these two person hold shares jointly, and A has already took a loan. Now, the bank should not give another loan to B against the same shares to circumvent this limit, right? Advances against mutual funds. So, units must be listed or have a repurchase facility. The minimum lock-in period must be over, and the loan amount should be linked to NAV, net asset value. For equity-oriented mutual funds, the margin requirements are same, 50% and 25%. For debt-oriented mutual funds, bank may set their own policies, and no loan for subscribing to another scheme or for boosting mutual fund sale is allowed. Advances to corporate or industrialists. So normally corporate or industrial borrowers should not be given loan against shares as primary security. Exception are there, so share may be accepted only as collateral for genuine working capital or productive loans, but certain conditions are to be fulfilled, like share must be in demat form. Promoters share also must be in demat where possible, and temporary acceptance is allowed, maximum 1 year. So it should be a temporary acceptance when borrower is waiting for long term funds. Promoters contribution financing. So promoter contribution is equivalent to equity investment in new company. So if bank lend against shares for this purpose, it is treated as investment in shares, which is a part of 40% capital market exposure. Bank can fund Indian companies for acquiring equity in overseas joint ventures or wholly owned subsidiaries, and Exim Bank can refinance uh, if it is approved. Again, no funding for non-compete fees or related activities, and even overseas branches of Indian banks must follow all these rules. Advances against debentures. So, a debenture is a written acknowledgement issued by a company stating its indebtedness to the holder. It is a form of long term debt instrument that carries a fixed rate of interest which is payable periodically. Debentures may be either secured or unsecured, and then mortgage debentures. So, these are secured by creating a charge over the company's asset in favor of trustee who safeguard the interest of investors. And then there are bearer debentures. Bearer debentures. So these are freely negotiable, payable to the holder, and do not require registration of transfer. Let's understand the advantages. Debentures are easy to sell, so liquidity is an advantage, especially if they are listed on stock exchange. Unlike shares, they do not fluctuate violently in the price, since their value mainly depends on the prevailing interest rate rather than the market demand. So they offer liquidity, they offer stability, they can be transferred at minimum cost, particularly in case of bearer debentures. So the transfer cost is low. Bearer debentures can be transferred by delivery and are treated as negotiable instruments, so negotiability is there. In liquidation, debenture holders rank higher in repayment priority compared to shareholders. So they have priority over the shares. And generally, debentures are backed by a charge on company property, giving lender an additional layer of protection. There are certain disadvantages as well. For instance, default risk is always there. So the company delays or fails to pay interest, debenture prices fall and their marketability reduces. Registration issues are there. If a charge on company property is not properly registered, subsequent charges may gain priority, reducing the banker's claim. And some companies may issue debentures without proper authority or borrowing power, making them invalid. They are ultra wires issue. Precaution which is required to be taken by bankers. So you ascertain whether debentures are secured or unsecured. Secured are always preferred. Verify the borrowing power of the company to ensure that the issue is within the permissible limit. Ensure the deposit of debenture certificate along with memorandum of deposit for demat debentures. Pledge must be created in borrower's demat account. To examine the nature and value of asset charge and monitor periodically to ensure security remains valid, and confirm that there are no uncancelled or redeemed debentures still in circulation which could dilute the lender's security. Loan against book debts. Book debt represent the amount receivable from customer on account of credit sales. They may arise in two cases: by drawing bill of exchange on purchaser, that is the bill receivable, or by debiting purchaser account directly, which is account receivable. Thus, book debt is equals to the claim of the borrower against buyer for goods or services sold on credit. So, borrower may assign these debts to bank as security to obtain the advances. So, let's talk about the legal basis and the conditions for valid assignment. So, they are governed by Section 130 of the Transfer of Property Act, which permits assignment of actionable claims. The procedure of assignment or the condition for valid assignment is that they must be in writing and signed by the assigner or authorized agent. The notice of assignment must be given to the debtor. An assignment can be absolute or by way of charge. Absolute meaning to say there is complete transfer. By way of charge, that the security is limited. Legal implication: so the bank can sue debtor directly in its own name, and debtor can exercise any right of set off against the bank that was available against the borrower. And future debts can also be assigned since they fall under actionable claims. Risk in lending. So, debt may be fictitious, old, or disputed, and the borrower may lack integrity and misuse the facility. Borrowers may fail to remit the collection to the bank, or giving notice to every debtor may be administratively very difficult. So, these are the risks involved in lending against the book debts. What are the factors which we need to consider before granting advances? So, number one is the integrity and credit worthiness of the borrower. So, it should be thoroughly verified. Secondly, the standing and reliability of the debtor company should be checked. Thirdly, finance should not be concentrated or receivables from a single buyer. Diversification should be there. Account should be audited and properly maintained, and the borrower must have an effective debt collection system. There are two methods of charging security. Number first is assignment, and number second is hypothecation. So by assignment, banks get the legal right to collect directly from the debtor, and when hypothecation is there, it creates only an equitable charge on receivables. Borrower continues to collect and must remit to the bank. There are three modes of financing book debts. Number one is factoring. So banks or financial institutions purchases the receivables at a discount and assumes collection responsibility. Second is forfeiting. Outright purchase of receivables. It is mostly used in international trade. And third is overdraft or cash credit. So against hypothecation of book dates, borrower operates the account under the agreed limits. There are certain guidelines for book date financing. You should restrict this facility to the first class borrowers of unquestionable integrity. Receivables should not be older than 3 to 6 months, depending on the bank policy. A book debt should arise from genuine trade transactions only, and the debt related to sister concerns, capital expenditure, or disguised advances, they should not be financed. Verification. So, sale invoices and data ledgers must be verified. Data confirmation should be obtained for outstanding dues. You check overdue position and reasons for long pendency, and ensure receivables are not concentrated on one major buyer, and bills that are already discounted returns should not be refinanced. Other aspects. So, obtain borrowers undertaking to remit all collection to the accounts. You should serve notice of assignment on debtors and seek their acknowledgement. In case of corporate borrowers, you ensure registration of charge with the registrar of companies. So these aspects should be taken into consideration. Loan against term loan. So bank often lend against their own term deposit. So fixed deposit, recurring deposit. Loan may be in form of demand loan or an overdraft facility, and security is created by a way of charge of the deposit receipt. So the form of charge created is pledge, margin and interest. So normally up to 90% of the deposit value accrued amount is advanced. So 10% of margin and 90% can be provided. For example, if the fixed deposit is of 10 lakh, so bank can grant loan up to 9 lakh rupees. Rate of interest charge is 1 to 2% above the rate payable on the deposit, and repayment by the borrower. Uh, Borrower may repay at any time before the maturity. On maturity, bank recovers the loan and interest first, and if there any surplus, it is paid to the depositor. And if deposit maturity proceeds falls short, then the borrower must pay for the balance. Deposit in minus name. Normally, no loan can be granted against FD in minus name. Exception is there that the loan to guardian for necessities of minor deposits can be given, subject to the undertaking by guardian that the loan proceeds will be used only for the minor's needs. uh, Discharge of receipts. So, bank obtain duly discharged deposit receipts from the depositors. If multiple holders are there, all must discharge and execute the loan document. If some holders cannot sign, an authorization letter from them is required, and the bank also obtain letter of appropriation authorizing adjustment of deposit maturity proceeds against the loan. Lien noting. So bank must note its lien in the fixed deposit register and on the fixed deposit receipt itself to prevent accidental repayment of deposit or deposit of proprietary and partnership concerns. So loans against proprietary concern deposits are not third party loans, whereas loans to partners against firm deposit is treated as third party loan, and it is charged at commercial rate of interest. Deposit held at other branches. So loan can be granted against deposits in other branches of the same bank, and the bank must mark lien at the deposit branch before sanctioning the loan. Deposit held by a company, sorry, a company deposit. So loan requires board resolution authorizing borrowings against deposit. There is no need to register pledge with the registrar of company, and loans against deposit held under capital gain scheme or tax saving schemes are prohibited. They are not allowed. Third party deposits. So loan may be given if third party FD holder duly discharge the FD receipts and provide a written declaration authorizing bank to adjust maturity proceeds towards the borrower's loan account. Deposit in other banks. So no loan against deposit with other banks are allowed. Reason being, original deposit bank enjoys a journal lien over deposit and may refuse to register lien in favor of another bank. Loan against gold. Banks often provide loans against gold ornaments for both agriculture and non-agriculture purpose. So this is one of the most popular form of secured lending in India because gold is widely held by households and can be easily valued. The charge created in gold loans is pledge. The borrowers hand over the possession to the bank as security, but the ownership remains with the borrower. Some banks also allow overdraft facilities against gold ornaments, giving flexibility to the borrower. So, what are the advantages, disadvantages, restriction? So, let's talk about them. First, let's understand advantages. So, before moving to restrictions, let's understand advantages. So, the evaluation is easy in case of gold loans. Golds can be quickly valued as its price are publicly available. Golds can be safely stored in bank's vault. Gold does not deteriorate easily and is only marginally affected by environmental factors. So, durability is there. It can be easily carried and shifted. Portability, price stability offered by gold loans is higher, and it often rise during uncertain times. So valuation is easy. Liquidity is also easy in terms of loans against gold because the ornaments can be easily sold since jewelers act as a ready buyer. Now let's talk about the restrictions. So no gold loan is allowed against the raw gold. So no loan against raw gold or the bullions, and loan is permitted against specially minted gold coins which is sold by bank. Again, the limit is 50 grams per customer, and as applicable in all other cases, the purpose should not be speculative in nature. Now let's talk about disadvantages. So ownership issues can be there because establishing ownership is difficult as ornaments are not always backed by purchase invoices. Now hollow ornaments are harder to value correctly. We need to destroy the jewelry in order to ascertain the precise purity. Jewelry fetch less than its market value because jeweler deducts making charges uh, for stones, and there's always a risk of theft and risk of loss. So handling and storage involves risk. Important aspects. So the gold loan must be given as per bank's board approved policy. So there should be always a bank board approved policy. Loan to value ratio is capped at 75%, basic meaning to say the banks cannot lend more than 75% of the value of the gold ornament or the jewelry. Rate of interest depend on the purpose of the loan, whether it is a agricultural loan or a non-agricultural loan. Agricultural loans often have lower rate of interest. So for agricultural loan, the repayment is linked to their crop cycle, and for non-agricultural loans, maximum 12 months if bullet repayment is allowed. A right of lien is there, so banks are allowed to hold the on gold jewelry for other overdues as well, right? In case of default, bank have the option to sell the loan. So if repayment is not made, the bank can sell the ornaments after giving a reasonable notice as per section 176 of the Indian Contract Act, and bank usually appoint professional appraisers for purity testing. So for this agriculture, it is harvest or marketing season. Now, what are the precautions which a bank must take while granting gold loans? So, ownership verification is very important. Borrower must comply with the KYC norms. Declaration required stating that ornaments belong to the borrower and he has full right to pledge them. Pledge or release must be done inside the bank's authorization room only. Appraiser must approve a jeweler which is appointed by the bank, and must provide valuation certificate showing description of ornament, fineness, gross weight, net gold weight, and value at prevailing market rate. The valuation of the gold is based only on the gold content and not on the labor or design charges. So RBI requires banks to value at the 30 days average of 22 carat price published by IBJA. Basically, this is Indian Bullion and Jewelers Association, and the ornament is less than 22 carats, then the value is proportionately reduced. Our preference is given to the hallmark jewelry for easier and safer valuations. Detailed record should be maintained in gold ornament register, and these ornaments must be stored in sealed bags which are tagged with loan account number and the borrower's name, stored in a strong room and fireproof safes under joint custody. Now, margin must be maintained. Loans cannot exceed 75% LTV, and normally it is provided for a period of 1 year. Gold loan is provided for a 1 year, which may extend to 60 months, which means 5 years. So the loan tenure is within 1 to 5 years. Ornaments must be returned after repayment. So part release is also allowed against proportionate repayment, ensuring sufficient margins are maintained. Delivery to third party should not be there. It should be avoided, but it can be done with borrower's authority and confirmation. If there is any default, again bank can issue the notice for repayment, and if unpaid, ornaments can be auctioned. Repledge of ornaments are not accepted to prevent misuse by the moneylenders, and ornaments must be insured against theft or burglary. Surprise check of pledge ornaments by an officer other than the custodian should be there in order to ensure the safety. Bullet repayment loans, so these are permitted for non-agricultural purposes with some special conditions that the loan amount should not exceed 2 lakh rupees. The tenure should not exceed 12 months. Interest is calculated monthly, but it is payable with principal at maturity. Banks maintain margin and fixed loan limit considering price fluctuations and accrued interest. Accounts become NPA even before maturity if margin is not maintained. So, we classify these accounts as non-performing assets if the margin is not maintained. Interest income should be recognized only on collection and not on accrual basis, and it is governed by RBI's income regulation and provisioning norms. Now let's talk about supply bills. So supply bill arise when a contractor or supplier executes work or supplies good to government department or public sector undertakings. So after supplying goods or completing part of the contracted work, the supplier or the contractor raises a bill to claim payment, which is in line with the terms of the contract. These are not negotiable instruments like check or bill of exchange. Instead, they represent a claim. They represent a claim or debt which can be assigned to a banker for advance to the bank for advance finance. Now, what is the procedure? Supplier dispatches goods and provides documents like railway receipts or bill of lading. For contracts involving work, an engineer's certificate of completion or progress is obtained. Once it is supplied, the supplier or contractor prepares the supply bill along with the inspection note or the engineer's certificate. The bills are to be submitted to the concerned government department via banker, and supplier requests banker to give an advance against these bills. Since supply bills are not negotiable instrument, the supplier must assign payment right to the banker. A revenue stamp is affixed and the supplier authorizes the department to make payment directly to the banker. What are the risks involved in advancing against supply bills? So there can be delay in payment. Government procedures are sometimes lengthy and advances may take long to liquidate. Bills may not be passed for full value if goods are defective, delayed or unsatisfactory. So there is a possibility of deduction. Government can adjust dues against tax penalties or damages. So counter claims can be there, set-offs can be there. And since the charge is by way of assignment only, it is almost like an unsecured advance. So what are the precautions which we need to follow? So finance only experienced contractors which are familiar with government procedures who scrutinize the contract carefully about the volumes, rate, period, conditions, and obtain an irrevocable power of attorney registered with the department authorizing the bank to collect the payment. You insist on inspection notes, engineer certificates with no adverse remarks, and then prefer financing against interim bills as they are quicker to realize and handle finance bills on collection basis due to delays. So we prefer interim bills for advances and not financial final bills. We keep the right to demand payment if bill remain unpaid beyond a specific period. Vehicle finance, we have also discussed vehicle loans in detail. I hope you remember when we discuss education loan, vehicle loan. So vehicle finance refers to loan granted by bank for acquiring vehicles either for personal use or commercial use. The security created is hypothecation. You does not take the possession of the vehicle, right? You allow the borrower to enjoy the possession and the ownership, but a charge is registered with the registration authority, with the RTO, regional transport officer. So the security, the nature of charge is hypothecation in this particular case. Now, valuation is very simple. Manufacturers publishes prices and market values are transferable, and vehicle lasts for years, but again they are prone to accidents. So they are somewhat durable assets, and being movable, vehicles can be hidden or relocated if borrower defaults. So mobility risk is always there, and ownership is registered with a regional transport uh, authority. Transfers without owner's consent is quite difficult. Charge creation, again, hypothecation is the charge created. Hypothecation charge is registered with RTA or Vahan database, preventing double financing. Risk is always involved because in case of default, the bank can possess uh, the vehicle, but vehicle depreciate faster. So security values get reduced quickly. Loan tenure should not be more than the vehicle's life. Maximum is 84 months, 7 years, but we generally prefer less tenure than that. Insurance should always be there. The vehicle should be insured, comprehensive insurance should be there. Bank's hypothecation again should be registered with RTA, and it must be endorsed in RTA records. Upon default, bank can seize the vehicle and sell it after the proper notice. Now let's check your progress. The nature of charge created while advancing against LIC policies, life insurance policies, it is assignment A. Is the correct answer. Document of title to goods has been defined under Sales of Goods Act. So D is the correct answer. In term of Section 19(2) of the Banking Regulation Act, no banking company shall hold shares in any company, whether as pledgee or mortgagee, by absolute owner of an amount exceeding 30% of the paid-up share capital of that company, or 30% of dash its own paid-up share capital and reserve, whichever is less. Loan against security of share debentures should not exceed the limit dash per borrower. If held in demat form, it is 20 lakhs. If it stays physical, then the answer will be 10 lakhs. So for question 4, C is the correct answer. Loan against minor term deposits. So they should not be granted in general, but they can be granted to the guardian of minor if it is for necessities of minor. So this is the correct answer for this question, C. Let's read other options as well. Can be granted if documents are signed if the minor has completed age of 14. No. Cannot be granted under any circumstances. Can be granted for necessities. Can be granted only with the permission of the court. So C is the correct answer for this question. LTV ratio in case of loan against jewelry, it is 75%. So B is the correct answer for this question. Let's move on to practice questions. Consider the following statements about the requisites of a good and acceptable security for banking lending. The borrower should have absolute ownership of the asset. This is correct. The asset should have frequent and wide price fluctuations. No. The security should be easily marketable and transferable. Yes. The security must be durable and easy to store. Yes. The market value of security should be easily ascertainable. So this is so 1, 3, 4, and 5 is the correct answer, making A as the correct option for this question. Consider the following statements about secured and unsecured loans. Secured loans require the borrower to provide acceptable asset as collateral. This is correct. Secured loans are also called clean. No, unsecured loans are also called clean loans. Secured loans reduces the credit risk for bank by creating a charge over the borrower's property. So this is correct. In unsecured loans, banks rely primarily on the borrower's personal integrity and creditworthiness. Correct. All secured loans are granted without assessing the borrower's future solvency. So this is not correct. So 1, 3, and 4 are correct. So 1, 3, and 4. This should be 1, 3, and 4. 2 is not correct. So 2 should not be there. So D will become the correct answer for this question. There is a typographical error in options. Which of the following statements regarding land and building as security for bank advance are correct? Land and building are considered self-liquidating asset and can be easily converted into cash. So this is incorrect. They are not self-liquidating in nature. Under SARFAESI, banks can sell mortgage immovable property without court intervention. Yes, in SARFAESI they can. So this is correct. Valuation of land and building is simple due to uniform construction standard. No, valuation is difficult to ascertain. Ascertainment of title is complex in India due to varying succession laws and incomplete land record. This is correct. Leasehold properties must have a lease period longer than the loan tenure for security to be valid. This is also correct. Bank must inspect and verify the existence and ownership of the property before accepting it as security. Correct. Rent Control Act may affect the marketability of the building offered as security. This is also correct. So 2, 4, 5, 6, and 7. 2, 4, 5, 6, and 7. Option C is the correct answer for this question. Consider the following statements regarding advances against goods. Advances against goods are usually granted for long duration to minimize the risk. No, they are granted for short duration. In case of hypothecation, the possession of the goods remains with the borrower. This is correct. The bank acquire ownership of goods when advancing loan against them. No, bank does not get the ownership. Banks get the possession if the charge is pledged, but never the ownership. The value of some goods may fluctuate widely, making valuation difficult. So this is correct. Key cash credit is associated with pledge of goods. So key cash credit implies possession with the banker and it is a pledge. So this is correct. So 2, 4, and 5 are correct, making option B as the correct answer for this question. Which of the following statements regarding advances against goods is or are correct? The borrower should have been dealing in goods for a sufficient period before an advance is made. So this statement is correct. Loan against a specific stock can be given for long period as the quality of the security is likely to improve. So this is not correct. The bank must obtain absolute or constructive possession of the goods. So this statement is correct. The goods charged to the why statement 2 is not correct. Some of you might be wondering. So as loan against specific stock should only be given for short periods, not long periods. That's why the statement is not correct, right? Statement number 4, the goods charged to the bank must have been fully paid by the borrower to avoid double financing. This is also correct. The borrower is not required to provide a written undertaking that the goods are not charged to any other. So borrowers are required to give an undertaking. So this statement is not correct. Goods should be stored in accessible godowns which should not be in residential premises or restricted access location. This is correct. So 1, 3, 4 and 6, 1, 3, 4 and 6, option A is the correct answer. Which of the following statements regarding documents of title to goods is or are correct? A document of title to goods can only be transferred by physical delivery, not by endorsement. So they can be transferred by endorsement as well. Hence, this statement is not correct. The transferee of a document of title to goods acquire the right to take delivery of the goods in their own rights. This is correct. Document of title to goods are considered negotiable instrument under law. So they are not negotiable instruments; they are quasi-negotiable instruments. So this is not correct. Bill of lading is an example of document of title to goods. Yes. Non-transferable warehouse receipts are considered document to title of goods. No, this is not correct. Non-transferable are not document to title of goods. The possession of document of title to goods does not automatically confers the right to possess the goods. This is correct because possession alone does not automatically confers the right to possess the good unless the document is transferred with a proper endorsement. So that's why the statement is correct. A bank can release document of title to goods to the borrower under a trust receipt without immediate payment. So this statement is also correct. So 2, 4, 6 and 7, 2, 4, 6 and 7 again. Option C is the correct answer for this question. Which of the following statements regarding advances against life insurance policy are true? Life insurance policies are always accepted as primary security for loan. Not always accepted. So this always makes this statement incorrect. Longer the life insurance policy has been enforced, the greater the surrender value. Absolutely correct. The assignment of the life insurance policy in favor of banks require many formalities and it's complex. No, does not require many formalities and it is not complex. So that's why this is not correct. If the borrower defaults, the policy can be surrendered immediately to the insurance company to liquidate the debt. Yes, this is correct. Insurance contracts are based on utmost good faith and any misrepresentation can void the policy. This is also correct. Life insurance policy can be accepted as security even if policy holder has no insurable interest in their life. They should have insurable interest and that's why this statement is not correct. Policies taken under Married Women Property Act cannot be assigned to the bank as security without specific formalities. So this statement is also correct. So 2, 4, 5 and 7. 2, 4, 5 and 7. Option B is the correct answer for this question. Which of the following statements regarding advance against shares are correct? Bank typically accept both listed and unlisted equity shares as security for advances. So banks can accept both, but for unlisted shares, bank can accept only in specific cases. So stating that bank can accept both listed and unlisted, so this is correct. But again, there is a caveat that only in specific conditions, only in specific cases, this listed unequity shares will be accepted. But again, yes, bank can accept both listed and unlisted. Listed shares are easier to dispose of as they have ready secondary market, correct. Unlisted shares are more commonly accepted, no. So this is not correct. Uh, Advances against share must be used for productive purpose only. This is correct. This is true in every case. Shares accepted as security must always be in physical form. No, they can be demat form, and demat forms are is preferred. They must always be in physical form is not correct. A pledge is a typical charge created. Yes, this is correct. Advances can be granted against partly paid shares subject to certain conditions. So yes, advances can be granted against partly paid shares as well, but proper precautions are to be maintained and certain conditions are to be met. So this statement is also correct. The statutory limit is this is 30% and not 40%. That's why this statement is not correct. Banks must regularly review the portfolio of shares taken as security, especially in volatile market conditions. So this statement is correct. 1, 2, 4, 6, 7, and 9. 1, 2, 4, 6, 7, 9. Option D is the correct answer for this question. Which of the following statements are not true regarding the bank's financing to employees for purchasing shares under employee stock option plans and initial public offerings? Bank can finance up to 100%, so this is not correct. Bank can finance up to 90%. So this is asking about not true statements. Keep that in mind. The total finance of ESOP is subject to a limit of 20 lakh, whichever is lower. So this should not be there. Is subject to 20 lakhs. Yes, so this is correct. Banks are allowed to extend finance to their own employees for purchasing shares of their own banks. So no, this is not correct. The this one is not correct. Banks must obtain declaration from the borrower regarding loans or advances availed from other banks for purchase uh, for purchasing shares. So yes, this statement is actually correct. The finance extended for ESOPs or IPO will be treated as capital market exposure and is subject to an overall ceiling of 40% of bank's net worth. This is correct. The financing rule for ESOPs or IPO do not apply to employees of other companies, only to employees of bank providing the loan. So this statement is not correct. So 1 is not correct, 3 is not correct, and 6 is not correct, making option A as the correct answer for this question. Which of the following statements about debentures is or are true? Are easy to sell, especially when listed. This is true. Debentures are not secured by any charge on the company's property, so they are actually secured. That's why not correct. If interest payment on debenture are irregular, it may affect their price and marketability. This is absolutely correct. Companies cannot issue debentures if they are in default of payment of interest or principal for more than 6 months. This statement is also correct. The bank should not verify the borrowing powers of the company before advancing loan against debentures. The bank should verify. Why the bank will not verify? So 1, 3 and 4 are correct, making option B as the correct answer for this question. Read the following statements regarding loans against book debts and identify the correct combination of true and false statements. Book debts are claims arising from trade transactions and can be used for collateral for loans. So this statement is true. The assignment of book debt can only be done with verbal notice to debtor. No. Written notice should be provided, not verbal. So this is false. A notice of assignment must be given in writing to the debtor. This is true. Factoring involves the outright purchase of the book debts. So yes, factoring involves outright purchase of book debts. So this is true. A debtor can exercise a right of set off against the assignee if such right exists. So this statement is true. The age of book debt should not exceed 6 months for them to be considered a valid collateral. This is again true. Loan against book debt can only be given to borrower who have sufficient credit worthiness and integrity. So while integrity is important, other factors are also considered. So only be given. So not true. So make it false. This one is false. So 1 is correct, 2 is not correct, 3, 4, 5, 6 are correct, and 7 is not correct. So option A is the correct answer for this question. Read the following statements related to loan against term deposit and identify which of the following combination are correct. Banks typically lend up to 75% of the deposit amount when granting loan against term deposit. So it is 90 and not 75. 75 it is in the case of gold loan. So this statement is not correct. So from options as well, we can solve this question. So if one is not correct, right? So option A gets eliminated and option C gets eliminated. Now option B and D, they have 3, 5, 6 and 8 in common. So we don't even need to read these statements. We don't need to read 3, 5, 6 and 8. 3, 5, 6 and 8. Let's see only statement 4 or 7 to determine which option is correct. So let's read option number 4. This is 1, this is 2, this is 3, this is 4. A fixed deposit receipt must be discharged by the depositor before the loan is granted. So this is true. So even if I don't read statement 7, there I can easily mark option D and move forward. Let's say you don't get statement 4. So you need to read, you have one more chance to solve this by reading statement number 7. So this is 9, 8 and this is 7. Bank note their lien on the fixed deposit register and receipt after granting loan to prevent any accidental payment of the deposit. So this is also true. So if you are sure about either statement 4 or 7, you can just simply mark option D and move forward. You don't need to read all the statements. So D is the correct answer for this question. Which of the following statements regarding loan against gold is or are correct? So let's use that elimination method we have just studied here as well. So we need to see uh, about statement 1. Bank can give loans against gold ornament for both agriculture and non-agriculture purpose. So this statement is correct. So option C is eliminated because it does not contain statement number 1. Gold loans must be covered under the policy framework by the bank's board. So this statement is also correct. So 2 is correct. 2 is not present in option B. Hence option B is also eliminated. 4 is common in both the cases. So we do not need to read statement 4. 3 is not present. So that means 3 must be incorrect. Hence we are not required to read statement 3 as well. So if you read statement, the nature of charge created against gold ornament is a mortgage. Actually, it is a pledge and not a mortgage. So anyways, this statement was not correct and we are not required to read this statement. We can skip reading statement 4 as well. Let's read statement number 5 to determine which option is correct. And rest of the statements, statement 6, 7, 8 and 9, I am not required to read. Let's read statement 5. Gold ornaments are generally not accepted as security for loans due to difficulty in valuation and ownership verification. So gold ornaments are accepted as security, we all know. So stating that they are generally not accepted as security. So this statement is incorrect, and valuation are also generally straightforward. So there are no difficulty in valuations. So the statement number 4, sorry, statement number 5. This is false. It is present in option D. Making option D as the incorrect answer, we can safely eliminate option D. So this is not correct. It leaves us with option A, and we are not even required to read other statements as well. But for our purpose, let's read other statements as well. So gold ornaments can exceed 75%. Can they? No. LTV should be capped at 75%. Valuation report should be signed. Uh, yes, should be signed by the appraiser and include all the details. Ornament must be stored in safe. Fireproof safes under joint custody supervision. This is also correct. And the bank should ensure that the gold ornaments are insured against burglary. Fire insurance is not necessary if the ornaments are stored in fireproof safe. So, fire insurance may not be necessary if stored in fire safe. So this statement is also correct. So even if after statement 5 I have not read statement 6, 7, 8 and 9, I can easily just mark my answer and proceed further. Consider the following statements regarding bullet repayment loan. So let's see option number first. Statement first, the loan amount sanctioned should not exceed 2 lakhs. This is correct. So this is eliminated. Interest on loans is charged, and this is also eliminated. Or no, this is not yet eliminated. Let's read statement 2. Interest on loan is charged quarterly and is due for payment with principal and maturity. It is charged at monthly, not quarterly. Hence, this is incorrect, and this makes option D incorrect as well. A also incorrect. Option C is the correct answer, and we can easily move forward. Which of the following statements regarding supply bill is or are correct? Supply bills arise in relation to transaction with government and public sector undertaking where a supplier submits a bill after fulfilling contract terms. This is correct. So option C gets eliminated. Uh, Statement 2 is there. Statement 3, statement 5 common in these. So let's read statement 2 as well. The supplier can obtain an advance against supply bill only after the bill has been fully verified and passed by the government department. No, this is not correct. So advance is provided even before full verification. So this is not correct. So option D is also eliminated. Statement 5 is common in both these cases. Either we can just read statement 3 or statement 4 and we can mark our answer. So let's read statement 3. Bank should prefer the final bill. No, bank should prefer the interim bill, not the final bill. So this statement is not correct. So option A gets eliminated. Automatically option B is the correct answer. So instead of reading all the statement, we prefer to use elimination method for these long statement based questions. So thank you for watching the session. If you have any doubts, don't hesitate to ask us on our Telegram group channel JIB CIB Prep. We'll meet again with unit number 26. Thank you for watching this session.